You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Hello, everybody, and welcome back to the Advisor's Option, the program that helps busy financial advisors and indeed their clients learn how to implement options into their portfolios. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. Up to 13 different programs for you guys to choose from now on said network. So it doesn't matter which part of the options onion you slice off and call your own. We've got something for you. If you're into the advisor spectrum, well, of course, you're in the right place. The Advisor's Option, of course, for the active retail segment. We have the option block for the more basic retail guys. We have Options Bootcamp and Options Playbook. If you're into unusual activity, we, of course, have Option Block and, indeed, the new Options Oddities program. If you're into futures and futures options, the long and short of futures options, and the futures options roundtable. If you're into volatility trading and all things VIX, well, then the Volatility Views program is for you. No shortage of programs for you. If you're into daily news, Options News Rundown, there's something out there. If you want the Industry Gab Fest, our little industry Charlie Rose, then our flagship Options Insider Radio interview program is for you. No shortage of different choices for you guys on the old network. And where can you find that stuff? Well, anywhere you find your finer online audio programs, including, of course, the mothership, theoptionsinsider.com. If you haven't been there in a while, I encourage you, surf on over there and check it out. A lot of great content, including a lot for advisors, a growing amount for advisors, breaking news from the options market, education, analysis, unusual activity, all that fun stuff, as well as all of the radio programs on our network. You can also find those in iTunes, Stitcher, Aha Mobile, wherever you find your finer programs. And if you want to find it all in one place, then, of course, check out our mobile app, available for iOS, Android, even the Fire OS system for those Amazon phones, all 8 of you out there who have those. So no shortage of ways for you guys to listen to our stuff, to find it, and then once you're listening, to send us your questions, your comments, your feedback. We'd love to hear from you guys. In fact, we're going to talk about a lot of your feedback here on the show today. But before we get to that, let me introduce my co-host here on the old Advisor's Option program. He is indeed the co-founder of Swan Wealth Advisors, Mr. Randy Swan. Randy, welcome back to the program, sir.
Thanks. It's great to be on here. I feel lucky or blessed that we just avoided our first hurricane in Puerto Rico since I've lived here. So I feel very good about that. Unfortunately, it hit Bermuda, but I guess my day will come eventually.
It seems like you have an inordinate number of disastrous weather stories when you're on the show. Back when you were in Colorado, it was the wildfires. Now it's hurricanes in Colorado. Remind me never to live within a few hundred miles of you, sir.
Well, that's true, but it's always exciting, right?
That's true. You can have boring weather like us here in the Midwest where it's just nice, and it's really cold. And that's about
and I will remind you of that in about 2 months.
Yes, that's true. You will be rubbing my face in it come January when it's back to, as we affectionately call it around here, Chiberia. Hopefully not as bad as last year when we were setting some dubious records. Speaking of some not dubious, actually great records, we got a ton of people writing in to the old show today. So we thought, why not take a few minutes and give you guys the spotlight and let you get your questions and your comments heard here on the old program. So I think without further ado, we're going to dive right on into a listener mail extravaganza.
Listener mail. Listeners write in. Mailbox.
You know, Randy, we do this show only once a month, so I always feel bad. We get people writing in and they have to wait so long. And then we sometimes get to it on one show if we have time. Sometimes we don't. So I thought rather than keep people waiting for months on end, we'd cram as many as we could here onto the old program. So I hope your listening ears are ready. You got your thinking cap on, Randy, because we got a lot of questions to get to. Going to kick things off here with a question from Luke Davis. He writes, "Hi." Well, hello, Luke. "I am wondering whether advisors are legally enabled to use any strategy that an individual might use in his own account. In other words, if I allow an advisor to invest a portion of my assets, may he use them for day trading, arbitrage strategies, etc. I have heard of U.S.-based unregistered advisors doing this for foreign clients, but refusing to do it for domestic clients. And I'm wondering if there is some compelling reason why they could not register and also do so. Thanks." This is an interesting point. This kind of refers back to something I've been thinking about bringing up here on the show, maybe devoting a segment or two to it, and that is all of the minutia behind the scenes that comes with using options from a regulatory, from a tax, from a legal perspective. Unfortunately, when you're talking advisors, that is indeed a significant portion of the story, and not one we get to very often here. We're usually getting into the nitty-gritty of strategies and execution and management and things like that, and not as much on the legal and regulatory side. It's not the most scintillating radio sometimes, but it is important stuff to hit on, as Luke Davis mentions here. Randy, you're knee-deep in this stuff on a regular basis, so I'll give you the pride of place here. What do you have to say for our friend, Mr. Davis?
Well, I guess I'd like to first start off by maybe define what an advisor is supposed to do and what a money manager does typically. So I always think of an advisor as someone that's going to understand the client situation, go through some analysis and discussions with their client, determine what type of investments are suitable, what type of risk tolerance they have, and hopefully design a portfolio that has the right mix of assets given their risk tolerance as well as their where they are in their investing career, I guess it was, and what their financial goals are. So I think fundamentally every advisor has to do that if they're going to hold themselves out as an advisor. And make sure that they're really taking their client situation into account, and therefore that's where you're paying them for. That's what their advice or their advisory fees is actually for, is helping customize a portfolio or program for that person. So when you get into, what type of strategies can you do? I mean, I fundamentally would argue that they probably can do any type of strategy as long as that client is suitable for that type of program. So, and to distinguish a money manager, we are advisors, but primarily we're money managers. And so what we do is we fundamentally operate our strategy, the defined risk strategy, which is a hedged equity plus option income strategy. Typically, other advisors are hiring us to sub-advise for them or manage a portion of their clients' money. And so We don't really do a lot of the suitability type work that a normal advisor would do. So fundamentally, we're hired to do our strategy, whether it's in our option overlay strategy or our mutual fund or our SMA program, or even some of the new products that we expect to be offering over the near term as well as long term. So that's just how fundamentally I define that whole basis of what an advisor is supposed to do. And I think that what people are having to do nowadays, that fixed income is we're in such a low yield environment. I think advisors are having to choose and find other strategies that may be traditionally outside the norm, and trying to find strategies that may kind of complete the portfolio. And I think that's where maybe the client or the question is coming from Luke. What strategies are appropriate? So I would argue all of them, provided that advisor is fundamentally comfortable with what their knowledge base is and what their clients' needs are.
We seem to have a lot of questions along this line today of what is appropriate for an advisor to be doing from an options perspective. And you're right, that is a good point, Randy, that we kind of use the term advisor as a bit of a catch-all here on this program, but there are a lot of segments within that term. There is the traditional financial advisor, as well as maybe financial planners get lumped in there quite often, as well as what you term the asset manager, the guy who's really implementing the funds. There's a lot of different career paths that kind of get lumped in under this rubric of advisor, at least the way we use it. And so sometimes maybe it's worthwhile parsing those out, because those people do have different needs and different uses for the product. I think it's also, you're right, it's worth mentioning too that I am not familiar off the top of my head with any prohibitions that would keep any advisors from doing exactly what you're talking about here, day trading, arbitrage strategies. I certainly know some active advisors who do all of that stuff. They will day trade on behalf of their clients. They will aggressively manage their positions and try to mitigate the cost of the protection that they're buying on their behalf and things like that. And as long as they're fully registered and as long as they have an account that allows them to have that sort of discretion and you've talked it through with them what you want them to do, I can't see any prohibition that would keep a U.S.-based advisor from doing this, particularly for a domestic client. I haven't heard of anything like that. I haven't had anyone approach me as an advisor saying, I really wanted to do some risk arb strategies for my U.S.-based client, but I was prohibited from doing so for X reason. So not a scenario I'm familiar with. So, Luke, as long as you find a guy you're comfortable with and you like him and you've laid out the groundwork of kind of what you expect and what you'd like him to do, and he's comfortable and has the skill set to do it, then you should be all set. I think the challenge there really just be finding a guy who can do all that stuff. This is why Randy's stuff like the mutual fund and others are taking off, because it's just there's a dearth of people out there who can offer that expertise, and a lot of advisors would rather just take a product like that or outsource to them and have them do it. So it's a tricky thing. If you can find a guy who can do it, by all means, cling to them like grim death, sir. Great question. Next up, we have a question from a listener who goes by the very enigmatic handle of Frank. He writes, my advisor has expressed concern in the past over the time commitment and complexity that come with using option strategies. He says I'm the only client who requests them, so he would be spending an inordinate amount of time for just one account. What strategies would you suggest to minimize his time investment and make him more open to the possibility of using options? Thanks for this program. Maybe my first suggestion, Frank, would be to find a new advisor. If there's a guy who doesn't really want to do what you want him to do, then that doesn't sound like he's the ideal advisor for you, unless you're really asking him to do some, things he's not comfortable with or something like that. Otherwise, you should find a guy, like I said with Luke, you should find a guy whose skill set matches what you need. If you want a guy who's going to do this more active stuff, and it sounds like that's what you're looking for, then you need a guy who is a little bit more versed in options, is a little bit more comfortable executing on a regular basis, and also can devote those resources to you. And that may be a little bit more involved, maybe even a little bit more expensive proposition, depending on how you set it up. But at the end of the day, if that's what you want, it might be worth it for you in the long run. Randy, what's your take here for our friend, Mr. Frank, whose advisor seems to be pushing back a little bit on using options?
Well, I think the first thing I'd point out is I think the industry is moving to advisors and managers that use options. So I think this is something that maybe 3 or 4 years ago was not normally acceptable, as the studies that we've talked to on the show in the past There has been a big change in terms of the percentage of the advisors and managers using options. So if your advisor is not willing to do that, I think that it's worth taking at least some of your money and going and finding someone that's willing to do it. Obviously, our strategy is something that you can invest in through a mutual fund through another advisor anyway. So that's one option you have, is finding managers directly using that advisor that you would want to invest with. Fundamentally, if you're asking an advisor who's, as Mark said, is not comfortable doing a strategy, that's probably not a good fit. But I think it's also realistic to assume that an advisor probably can't afford to spend a lot of time doing a one-off strategy for you. So that's just another example of why you probably wouldn't want to use them for that. I think it's not, these types of strategies that we employ are not something that are easily doable, especially on an SMA or a large account basis. So it is asking a lot probably for an advisor that doesn't do this in a normal course of business to really devote a lot of time. And I'm not sure he could, even if he could do it from an intellectual or perspective, whether or not he has the scale to really do it right and allocate or dedicate the amount of time it takes to monitor positions, all times during the day or the trading day. So for all those reasons we mentioned, I think it's better to find someone else to help you out with that portion of your portfolio that you want to allocate to option strategies.
And of course, that's been a big driver of growth for you guys, is essentially advisors coming to this. Sounds like the same scenario that Frank's advisor does, where they don't have the time or the resources or the wherewithal to do it on their parts, and they could sub-advise out to you guys, or perhaps pick up the mutual fund or some of the other approaches people have taken, and that's been a way for them to kind of get some of that expertise without having to develop it internally on their end, which could be a daunting prospect for some of these guys.
Our growth over the last 3 years has been almost entirely through other advisors that see a need, see a demand in the marketplace for something that we do. And so we're excited about the future growth that not only us, but other firms like us in the industry, this space is going to get much more crowded over time due to the explosion in demand for alt-type strategies.
Yes, and I think unlike a lot of other places where people might say, oh, well, we don't want, competition, I think you guys probably would agree that it's actually a good thing to have more players in this space, because it increases the quote-unquote legitimacy of option strategies to a lot of the large pension and hedge funds who otherwise may not allocate to it. They say, hey, there's a lot of growing impetus and momentum behind this space. Maybe we should check it out. And it gives you, at the end of the day, a rising tide lifts all boats in that space. So I'm certainly you're happy to have a lot more players jumping in and just driving more assets and resources to options managed type strategies.
Well, it's true. Having the education and the awareness of options, it's also true that, fundamentally we do what we believe in is the best strategy. So we feel like I always use the analogy of using the direct approach to managing market risk is using options, and using the indirect approach is more of the kind of the asset allocation model of trying to diversify away. We always fundamentally believe that market risk can't be diversified away, and so using options is a good avenue to go and get what you want out of your portfolio.
That said, Frank, if you're dead set on keeping this guy and you want some strategies that would be simple for him to implement, that don't take a lot of time. We've talked about a bunch of those on this show, including the simple protective put that doesn't take a heck of a lot of time or wherewithal to really implement properly. Then, of course, there's a covered call for a little bit of income, and, of course, you could combine the two into the collar. Those are kind of the three bread and butter positions for most long-only equity financial advisors out there who want to look for risk management and perhaps a little bit of income. Or you can go the Randy route and kick those up a notch and actively manage the overlay and get into things like put spreads in addition to just the puts to minimize the outlay and improve the returns and things like that. But that gets to a higher degree of sophistication than what your typical advisor is going to bring to the table. So if he wants to just kind of set it and forget it, he can do the 1 month covered call, the 1 month zero cost collar, things like that. Then he only needs to adjust and roll once a month. And as long as you're happy with that, then that could be a viable path for both of you as well. All right, next up we have a question. This is one, they mention you by name, Randy, so put your listening ears on. This one gets into the meat and the potatoes a little bit. It's a question from Lucas Newell. I don't want to butcher your name there, Lucas. He writes, I've got a question for Randy from Swan. So, Randy, I believe that is you. And he writes, he talked about buying 2-year leap puts and then rolling them at the 1 year mark. Why the 2 year period? Would it be cheaper and perhaps more effective to use 1 year leaps and perhaps rolling them when they hit the 6 or perhaps 4-month period. That would save on the initial premium outlay, but also avoid the rapid time decay period that occurs in the final 2 months of an option's life. Can you talk a little more about the thought process that went into selecting the longer-term put versus shorter term, as well as the roll period? Well, Randy, Lucas is, of course, referring to a discussion we had recently on this program, probably several times actually, about the way you guys actually construct your overlays over there at Swan, typically using a 2-month or so time frame long put, and then adjusting or rolling it when you get to that 1-month time frame. And Lucas wants a little bit more insight into your thought process as to how you arrived at those 2 individual time periods for the puts.
Great question. Let me start off by addressing it from a higher level perspective than just getting into whether it's a 2-year, 1 year, whatever length of option. I mean, fundamentally, I think there's 3 factors that we use in deciding and structuring our strategy and operating our strategy. Fundamentally, longer term options are going to decay at a lower rate per day, everything else being equal. So we would argue that longer dated options are going to save you money over time, under our normal assumption. I think the second issue that comes up when you buy shorter dated options, hedging with shorter dated options versus longer dated options is, do you really want to be in a situation where you're forced to rehedge your portfolio when the market, to use an analogy of 2008, your house could be on fire and you're trying to buy insurance on your portfolio or your house, and it becomes really expensive during times like fall of 2008. In fact, we've heard of other firms that got in trouble like that because when they tried to buy their insurance on their portfolio, it really wasn't cost effective, and they were having to outlay a big percentage of their portfolio just to provide some level of protection. And of course, that was really prohibitive. And so that's another issue of the timing of the rehedge. That relates to how short of duration you're buying. The third issue that we bring up a lot is the actual concept of compounding losses. The shorter duration you go when you hedge your portfolio, the more frequently you're going to have to do, and it's harder to actually structure what type of loss payout you do. We've gotten in the habit of structuring longer term protection over a year. So when we hedge over a year period, we're actually able to define the risk on that year period with certain assumptions for time decay as well as volatility. So you don't have a situation if you were trying to hedge on a quarterly basis where you could say, I could lose 5% during that quarter. What happens the next quarter when you rehedge the portfolio, the market drops another 5 or 10%, you could be out 10% and so on and so forth. So the more frequent, the higher frequency that you try to rehedge your portfolio, the more susceptible you are to what I call compounding losses. So from a big picture perspective, that's how I would describe why we choose to use the longer dated options. Now, we can get into a concept of having something less than a 2-year. I would absolutely like to have that conversation, but fundamentally for us, we're trying to do it on an annual basis. I think most clients, especially most retail clients, are used to the concept of doing things on an annual or a calendar year basis, and so that's the way we've chosen to do it. Mark, you may want to get into the kind of the time decay curve of an option going out 3 years to expiration and how it's so exponential as it goes to expiration. That may be a good side topic to talk about.
Yeah, data, one of our favorite topics here on this program and indeed on the network. And you're right, it does start getting a little bit steeper as you get towards the shorter duration of the curve. Where Randy and you guys are really playing is on the much longer term end of the curve, where you're right, time decay isn't as much of an issue. And a lot of people, sounds like Lucas as well, tend to focus on that initial premium outlay as being the fundamental driving factor of the trade. And certainly that is a concern, particularly if you're overpaying for a position. But you also have to factor in over the lifespan of what you're looking at for the investment. And if you had to do a lot of short-term little investments versus longer-term ones, how they're going to add up and compound, like Randy said. And when you get into a lot of the shorter duration stuff, that is when the theta really kicks in, particularly in that final month or so of that option's life, when it just gets extremely steep, and the final couple of weeks when that theta is approaching exponential increases, and that's when you really don't want to be playing in that range. So Randy, you guys, the way you structure your portfolio, you tend to avoid that. There's an interesting side note to this. We are recording this, listeners, on Tuesday, October 21st. It is in the middle of a very tumultuous period in the market. We don't have a listener question about this, but it kind of dovetails off what Lucas is talking about here, Randy. Maybe you can give us a little bit of insight, because it was such a tumultuous week last week. The market down 2% and then up again and then unched on the day. What kind of adjustments did you guys have to do, if any, to the portfolio, and how did the overlay portfolio perform in that type of scenario?
The first point, as I tried to allude to a little while ago, when you're structuring and you're buying insurance on a longer-term basis, movements like what's happened over the last month or so are really almost a non-event. I think that's pretty important, that we're never in a situation where we're under duress to have to make an adjustment. Now, we may make adjustments. In fact, we did make some adjustments on our income portfolio, but that's with a very small percentage of the portfolio. So it really allows us to be, I think, more strategic in nature and long-term in nature, and not worry about the short-term fluctuations. Getting back to the cost of an option and how much you want to invest in it, of course, our strategy always combines income components of that. So when we look at the structural cost over the long haul, there's two things I'd like to point out. And actually, we wrote this up in our Good, Bad, and the Ugly, the most recent version, I think, that came out in probably late July, August of this year. We actually show the long-term cost of our put protection, not only on an individual annual basis, but on a cumulative basis. And as we go through bull and bear markets, yes, it's a cost during bull markets. And yes, we can't outperform the market. We always are typically going to underperform the market. But over the long-term cost, it's been relatively small. And so that's philosophically the way we come down on this, is that we're a long-term hedging program where we're not out trying to predict or time the market and say, hey, this is a good year to hedge your portfolio. Next year won't be a good year. So fundamentally, structurally, we're committed to the long-term hedging of our portfolio because we feel confident in our short-term ability, historically speaking, to be able to generate income to help pay for some of those costs. So I would just add the current market condition. We like higher volatility for our income trades. It gives us a higher probability, I think, of profiting and generating premium over time. It's even better when you hedge a portfolio at a low cost and you go to a higher volatility environment. So I like higher levels of volatility, everything else being said.
That's one of the reasons I wanted to bring up that point, is people may be initially scared off by the prospect of a longer-term put, but it does give you quite a bit of flexibility. And in a period like last week where people might assume how you might be scrambling to adjust, you do have a little bit more flexibility because you have that longer-term component. You're not putting on new hedges every few weeks or every few months, and as a result, you're kind of compelled to adjust on a much more frequent basis. It does give you guys a little bit more flexibility, and again, that's why I wanted to point that out for someone like Lucas who may be concerned or wonder why you'd want to do that. That is one of the benefits of taking a little bit longer-term approach to a position like that. A, it's not decaying like mad, and B, you get a little bit more flexibility in periods like last week to choose your spots and pick your poison as to when you want to adjust or if you want to adjust at all. All right, great question so far. You guys are really knocking it out of the park. We got time for a few more here. Let's go to next one from Mitch76, and he writes, can you talk about the place that individual equity options should have in your portfolio versus broad indexes? Judging from previous episodes, it seems that the bulk of your focus is on indexes. Is that due to the volatility risk posed by individual names like Apple and Netflix, etc.? Would an overlay or a holy grail collar approach even be as effective in individual names versus indexes? Or are they better suited to premium harvesting strategies like iron condors? Great program touching on a very underserved area of the options market. Well, thank you for that, Mitch. And I'll start this off, and then I'm sure Randy will want to dive into why they choose the indices, because that is where they play primarily. But a lot of the strategies we talked about here, including what I like to call the holy grail, the collar, they are indeed very suitable for individual equity names. In fact, that's where we see the lion's share of their use case. There are certainly no shortage of people writing covered calls in individual equities. There are certainly no shortage of people buying protective puts in individual equity options, and certainly no shortage of people doing zero cost and regular collars out there in individual equity options. So they would be as effective. That's not a question. They have a similar skew relationship to the index. They both trade, essentially, equity options and index options trade in what we call investment skew. That is, of course, the puts have a little bit of a premium to the call, sometimes a little, sometimes a lot. Depends where you're looking. It's going to vary depending on the scenario, getting a little steep out in the indexes these days from a skew perspective. And so you have to bear that in mind when you're constructing these positions. So if you're buying a put, you're probably going to be more compelled to look for places to offset some of that premium, hence the collar and the other income strategy we talked about here on this program. But long story short, there is some more individual volatility risk to a lot of these names. They do fluctuate more wildly than an individual index is going to be. That's just the nature of the beast when you're trading an individual name versus a broad market index. It's harder to move a broad index, as you might imagine, than it is an individual name. So there is a little bit more volatility, perhaps a little bit more movement in the underlying. That said, is not every individual name is not going to be more volatile than the S&P. It's kind of a case-by-case basis. So long story short, those strategies do work, and they are effective, and people do like them and use them en masse in a lot of these individual equity names. Now, Randy, you guys play primarily in the broad indices, and that's, I'm sure, for a lot of the reasons. A lot of the advisors that come to you want to hedge broad portfolios, so you guys turn to the indices, and a lot of other reasons as well. I won't put words in your mouth. I'll let you tell our friend here, Mitch76, why you guys prefer to play in the broad indices rather than the individual equity options.
Main reason is that our firm philosophy has always been based on market timing and stock selection are difficult, if not impossible, over long periods of time. So fundamentally, we believe the value that we provide is in the hedging and option income components, not necessarily in trying to pick stocks. Now, that being said, our firm also believes that we're somewhat agnostic as to the underlying. So when other people, other firms or individual clients want to hedge let's say a low basis portfolio or a concentrated stock position, that's where the customization of our option overlay program actually comes into play. We're willing to do the customized hedges. So I agree with you, Mark, that it's absolutely a valid approach to be able to do it. It's probably represents about 10% of our business right now, and so we love it as a long-term strategy. But fundamentally, it's just philosophy of what you think your really value is. And so as we get bigger and offer more products, as something that we've talked about in the past, we're launching additional mutual funds based on other indices around the world, different assets. Our fundamental philosophy is that, hey, we can apply the defined risk strategy to whatever underlying asset provided there's liquidity. Second reason why we like the indices, and this is actually relates to the next question I'll just briefly touch on, is when you play in the indice world, especially as it relates to something like SPX and RUT and stuff like that, you get to use options that qualify for the 60-40 treatment. I'll just kind of hold that until the next question comes up.
You're jumping ahead of me, sir, but I like it. I like your enthusiasm. That's good stuff. But that's an interesting point you bring up about the different asset classes, because, of course, all the strategies we talk about here, Mitch and others, are appropriate to a variety of asset classes. In fact, we touched on that in the last episode, talking about futures options and how they work as relate to equity and index options and how you can apply a lot of these same strategies, collars, covered calls, and things to those products as well. They're not limited to one asset class or one underlying. They work across them all. They may perform a little bit differently, but they are fundamentally, end of the day, still the same. But that's an interesting question, Randy. You mentioned the other asset classes. Someone here like Mitch writing about Apple and Netflix and some of the high flyers. Have you guys over there at Swan ever thought about maybe doing something like that? I mean, Apple these days is almost an underlying and an index unto itself. Have you guys ever thought about coming out and saying, hey, how about let's say, an Apple overlay type strategy or mutual fund? Has that ever crossed your minds over there?
We don't really go out and choose a certain stock to do it on, but we have had people that are executives or people that have really big positions in a certain stock. I'd rather not give out names, but we have things like that where we will say, yes, then we will help you do that. It's usually them coming to us. But I think it's, like I said, I think it's a valid strategy. We just have to choose, when the demand is there to offer that type of strategy.
I got to say, I think an Apple overlay strategy or a mutual fund would have some resonance to it. A few people might want to buy that fund, I think. I'm just putting it out there. And my marketing / consulting fee check is quite nominal, so don't worry about that. All right.
That's great.
You mentioned the next question, so we'll dive right into it here. This is from Timothy Andrews out of good old Spokane, Washington. He writes, can you talk about the influences of 60-40 tax treatment on your option strategies? Great question. Again, this is why I've kind of toyed with for a while about doing an episode just about all this kind of stuff, because there is so much in the minutia of the way these things are taxed and treated from a regulatory perspective. He's, of course, referring to the way some products are taxed versus others. Randy, since you were just about to get into it, I'll let you get the ball rolling. What's your take here for our friend Mr. Andrews on the influence of that type of tax treatment on your strategies?
Well, what he's referring to is Section 1256 contracts. That refers to a section in the Internal Revenue Code, and that is a provision in the tax code that allows certain types of options on broad-based indices to be taxed 60% long-term, 40% short-term, regardless of whether or not you've held them long-term or short-term. You also have to market on an annual basis. So fundamentally, anytime we have a choice to use a product on a market like that where we can actually use the 1256 contracts, the options on those contracts, we would obviously use it because we think it's beneficial. So we love that. That's based in our mutual fund. In fact, our mutual fund's based on the select sector spiders right now, and we hedge it, and we do our option income strategies using the SPX as well as some of the other broad-based indices. So why would you not want to use it? Everything else being equal, it's going to lower your tax bill. It's going to deliver a higher after-tax returns. Everything else being equal, assuming you make some income. And so when we have a choice, we're going to use it. When we don't, we obviously couldn't do that. In our SMA program, some of our smaller accounts that can't use SPX just the size of the accounts, then we would obviously have to use some other option that doesn't get that treatment.
Yeah, that's why a lot of people like to flock to SPX in addition to the value it brings from a more meaty, sizable contract than, let's say, a SPY, but also it brings that 60-40 type tax treatment to the table, which is hugely advantageous to someone out there who's trading these products anyway and has a use case for the type of size of an SPX product like you guys do over there, Randy. It's a no-brainer. Why would you use that as opposed to a product that doesn't give you those sort of tax treatments? So usually those products, like I said, are usually a little bit larger in size and value. So be aware of that there, Timothy, that, if you're going to use these, they may not be suitable for everyone. And if it's not suitable for you, that's fine. You don't have to use it just for the tax treatment. But if it is something that works for your portfolio and it just works for your strategies and you can handle, all the contract specs of those contracts and the size accompanying them, then by all means, it's a much better road to go. Why pay the taxes if you don't have to, if you're getting essentially the same exact product elsewhere just with worse tax treatment? So by all means, if you can use it and you understand the benefits, or if you don't, maybe talk to your accountant or your tax advisor who can explain it to you in a little bit more detail. But at the end of the day, it's a better way to go if you can handle it. It's certainly a good one. A good question too, Timothy. Good one, Herrick. All right, next up. This one's an interesting one, and we could certainly probably spend the rest of the episode on this one, Randy. This is a question from Neil Magny, I suppose, and he writes, question for the advisor's option. What questions or topics would you like to see on any forthcoming option certification or test for financial advisors? Trading, regs, a bit of both. Thanks. Neil, this is a topic that is near and dear to my heart. I've touched on it many times on the show. It's one of the reasons our friends on the OIC are such an active part of this program. They couldn't make it this episode, unfortunately, is because they would be at the forefront of those types of initiatives. And you're right, it is a problem in this space that we have, Series 7, Series 63s, and CFA exams, and someone can go through that entire testing process and really come out of it on the other side with, I think, to be charitable, a limited understanding of options. Certainly not to the degree that you would want someone managing your portfolios to have that sort of level of understanding. They're not going to have that. They may understand some of the minutiae of the behind-the-scenes regulations. They may know what a call, what a put is, and that's probably about it. So we've talked about this behind the scenes for quite a while, and this is, quite frankly, one of the things that is missing from the options market right now. And there was some momentum to get this done, and then Bernie Madoff came along, and it pretty much scared the hell out of all the exchanges and firms like OCC and others who would be behind something like that, because they suddenly realized they could certify someone who could then go out and blow out 1 million grandmothers in Iowa, and they would be on the hook for that. So that kind of spooked people from doing this. I know there are some one-day classes that OCC does and others that help to at least give you a little certificate you can hang on your wall as an advisor, but those are 1 or 2 day events. They're not really in-depth questions. So personally, what would I like to see? First off, the regs. I'm sick to death of the regulations. I think too many exams right now. That's pretty much all they focus on. People assume that these trading exams test your proficiency as a trader and as an asset manager. They don't. They test your knowledge and understanding of the law and of the regulations. And that's what the regulators also care about at the end of the day. They don't care if you can implement these products in an effective manner. They just care that you don't break the law. And so that's what the focus of these is. I would certainly want any options exam to focus on the former, the trading and actual implementation part as well. So I would certainly say it starts off with a good overview of options. You have to know calls versus puts. You have to know put-call parity. You have to know the Greeks, delta, gamma, theta, vega. All that kind of stuff should be tested in maybe the intro part of the exam. And then maybe to tailor it toward advisors a little bit, because I'm assuming this is an advisor certification you're talking about, then I would like to see maybe a couple of sections. One for risk management, where you get into volatility and things like tail risk and skew and how that impacts a position and how you could adjust that by perhaps doing put spreads versus puts, and where you can go on the skew to actually minimize the impact, and some strategies that take advantage of high volatility situations, some strategies take advantage of low volatility situations, and really walk an advisor kind of through the benefits that can be gained from a volatility, from a standard deviation, from an overall risk management perspective, from incorporating things like a long put into an equity portfolio and things like that. And then the second component of that would, of course, be income. That's what advisors are really interested in. So having a second portion that tests their knowledge of income, covered calls, short puts, wheel trades, all those types of trades we talked about here on the show, and how they can combine them into things like zero-cost collars. I would love a test that kind of hits on all those things. So that's kind of the bread and butter of what an advisor should really know. And then if a guy can go through all that and handle a lot of that, he's at least equipped to come out and handle the basic needs of the proverbial grandmother from Iowa who wants to come there and give him her stock portfolio and say, hey, please manage my risk and also perhaps maybe get me a little bit of income and improve my returns and reduce my overall standard deviation. So I would like to see something like that. I don't have any pie in the sky dreams of that it would go beyond that to test, things like position management and adjustments and things like that. Those would be maybe higher level. Maybe that would be like the series 2 or 3 version of that. Once they get beyond that, they can go different stages. And that might be an interesting approach to take with it as well. But that first level, that first rung should at least, I think, cover those topics. There you go. I've gone on for quite a while. Obviously, this is a topic that's near and dear to me. Randy, what would you like to see in a very dedicated options certification type exam?
You know what? I'd actually like to see 2 sections. The section for the first one that you mentioned, just basics of options, how they're priced, how they change, the pricing moves over time, just basic strategies. I think the second thing is for advisors. I mean, what are advisors really doing? They're not really called on to actually execute or implement the strategies per se. They should be finding other managers like us that are actually implementing our strategies. So they should become proficient on actually evaluating different types of strategies and how that would fit in with various portfolios. So I think that would be something I think that the advisors could actually get some knowledge out of, to be able to really, truly evaluate competing strategies of what's is a covered call strategy, what kind of returns is that going to hopefully generate over time? What is a collar strategy? How would that work? Maybe a put selling strategy. I think that would be beneficial for an advisor in general to evaluate different managers and different programs.
So a section on sub-advising, essentially, and how to pick the right sub-advisor.
Yes, exactly.
Now, there is some interest in something like that, because there is a problem with a lot of advisors out there. Maybe not picking poor sub-advisors so much as picking very poor products. There's a whole industry of structured products out there that offer, I think, to be charitable, suboptimal products that replicate a lot of what we're talking about here from an options perspective. They'll sell you some sort of structured product that will replicate a protective put and charge you 4% to do it or 5% to do it, and it won't work as well as just going out and buying a put. And there are a lot of those things floating around out there. So maybe there is some truth to that, Randy, that it needs to be something maybe at least that can disabuse advisors from the notion that they can pretty much only go out and buy some sort of closed-end product or some sort of structured product, and that's pretty much the only way they could go, that they can actually construct these themselves or at least determine which of these 2 products is more effective overall. So I agree with you in that sense, that there should be some sort of some sort of comparative analysis in there as well. All right, next up, we have people are asking some interesting questions here. This is from a listener who goes by the handle of the Inca. He writes, this may be a touchy subject, but it's important. What is an appropriate pay rate for option advisors? Is it the standard 2 and 20%, some flat hourly rate? Since they're doing more, should they get more? What should I look for when I'm picking one of these guys? Another interesting question here, Mr. or Mrs. the Inca. And you're right, there is kind of this perception out there that these advisors, if they are doing what we're talking about, if they're actively rolling and managing and adjusting on a daily or semi-weekly basis, these different positions, that they are doing more than a standard, buy and hold type guy, or 60, 30, 10, okay, you're done, come see me again in 6 months. So perhaps people think they should be paid more. And that's an interesting thing. That's something certainly you have to work out with your advisor. I think at the end of the day, though, these guys, they're doing a lot more. But this is something we should start to expect more from our advisors. People have, I think, just had low expectations for so long that they're kind of blown away when these guys are actually doing what they should be doing, which is adjusting and managing your risk and helping you implement these things in a risk-effective and appropriate manner for your risk tolerance and your portfolio and all that other fun stuff. So I think maybe we need to adjust our expectations a little bit, that these guys getting the 2 and 20 and everything else are doing essentially exactly what we should expect from them, and they probably shouldn't be getting more, but that's essentially what you should expect for that rate. And if your guy is not doing that and you're paying him somewhere in that, either that with a percentage or just maybe a straight out flat percentage or a wrap fee or whatever your structure is, what you're paying for that, you should expect more for that. So if your guy isn't delivering all these things we're talking about, or he won't perhaps sub-advise out to someone who will do that for them, that you like and that you both can agree on, then probably you should be looking elsewhere. So rather than saying, hey, maybe some of the advisors out there are getting mad at me saying, we should charge more. But at the end of the day, I think you guys should expect more from your advisors. And if they're not doing this for you, then they should be willing to find someone else and some advice to them, or you should find someone else on your own. Randy, again, a touchy topic of compensation. Not everyone likes to get into it, but it is important when we're talking here. What do you have to say for our friend, Mr. or Mrs. The Inca?
I think it's a great question. I mean, Swan has always been a fee-based advisor/manager, and so we've never had a performance fee. The concept of, are you doing a lot more or not? I don't know. I mean, I think that fundamentally people have a different, money managers in general have different angles on how they're trying to provide value to their clients. Fundamentally, we spend more time on the structure of our strategy and executing our strategy in terms of the options income trades that we do. We obviously don't have to fly around the country and meet different CEOs and make market calls and do technical analysis per se. So I don't look at it, what we do, is any more or less expensive or hard to do. It's just we put our energy into different. Some managers try to pick stocks based on fundamentals, some pick based on technical analysis, and we don't really use any of that, very little in that in our actual money management. So fundamentally, I'm totally comfortable doing it on a fee based, and we don't charge a performance fee. I think that the more speculative type of strategies are actually out there, you're probably more likely to have a 2 and 20. And that's probably going to get a lower allocation from your portfolio. And so you probably would get a little higher fees. But generally speaking, our view has always been our strategy is really trying to do a strategy that's based to fix some of the problems in portfolio management. And it's a big, broader asset class. We get higher allocations than maybe a lot of other managers that are doing specific types of trades like credit spreads or things like that, where they may be more intensive and get a smaller allocation. So we're very comfortable where we're at pricing-wise.
There you go, Mr. or Mrs. The Inca. 2 votes here for your pretty much standard fee-based type system. If your guys are charging you a heck of a lot more, then maybe you should revisit that, or they should at least be delivering something commensurate to that, what they're charging. And if they're not, then perhaps you need to rethink that. But yes, you might think we'd be on the other side of the fence saying pay more, but we're not. I think you guys should expect a lot more from your advisors. And hopefully after listening to a show like this, you know what you should be looking for from those guys. All right. We got time for one more here. This comes from Mr. or Mrs. J. Ingrasali, and they write, question for the Advisors Options Show. Hello, everyone, and thank you for your time. I'd like to know what you consider to be an appropriate level of options involvement for a typical financial advisor. Should I just expect them to have a basic understanding of income and risk management, aka protective puts, covered calls and collars, or should I expect them to facilitate my active trader mentality with strategies such as iron condors, butterflies, time spreads, etc.? I guess what I'm asking is how active should my advisor be with options? If I expect him to help me adjust and roll my positions, am I asking too much from a guy with dozens of other clients? Well, this is kind of similar to that earlier question we had from a couple of people, from Frank and from Luke, regarding how involved, I guess, at the end of the day, your advisor should be from an options perspective. And that kind of gets back to what Randy was saying earlier, too, about, I guess, it really kind of kind of depends on what role your advisor is falling into. If he's kind of just your financial planner, who's kind of helping you set your life goals and kind of being more of a 10,000-foot kind of guy, then probably not. You shouldn't expect him to come in here and roll your iron condor swaps and all the other fun stuff you want to do. If he's a more active asset manager type guy, then you definitely probably want to have him on top of this kind of stuff, or at the very least you should, discuss it with him that, hey, I would like to do this. And maybe you set it up where he can kind of do some of the big picture stuff, and you have a discretionary portion of the account that you can manage, and maybe you do it in conjunction with him. Maybe he's just aware of it, and that's where you can maybe do some of the more crazy stuff that maybe he doesn't want to do or isn't equipped to do or doesn't have the time to do because he has other clients. Remember, these guys are usually pretty busy at the end of the day, so you can't expect them to spend 90% of every day on your accounts. But that said, I think definitely, like we said on the show many times, they should all have that basic level, and that gets back to that certification thing we were talking about before. Unfortunately, they all don't because that certification doesn't exist. So for now, just getting one who has that basic level of understanding is a very rare thing. And if you get one of those, you should be very, very happy that you found one. If you found one that can do the next level that you're talking about, your covered, not your covered calls, but your active trader mentality, as you put it, the iron condors, the iron flies, the time spreads, that's a very, very rare beast indeed. And you should definitely, if you like what they're doing and they understand your process and they work with you, you should definitely stay with that advisor. But I think the base level of expectation we want you to have here on this show is kind of what you mentioned in the first thing, the income and the risk management. They can do that for you. Maybe you can do the other stuff yourself in a separate kind of discretionary portion of the portfolio that you help manage, and then everyone's happy. And then you don't have to worry about that guy having to do that, or maybe him not wanting to or having the time to do it. So that's a good way to do that if you want to keep everybody happy, but also stay with a guy who you think might be pretty good in the long term. Mr. Randy, where do you fall here for our friend Jay Ingrasali?
I think it would be very difficult for me to help a client of mine to execute his strategy, so I wouldn't be interested in that at all. I would be surprised if other advisors that may not be as knowledgeable as our caller would be able to really help manage their strategy effectively. So if they're doing those types of strategies, they should probably do it themselves.
Yeah, kind of like a separate discretionary type account, and maybe they have the advisor check in on it every now and then, or maybe they just keep it to themselves, and that's kind of where they do their, I don't want to say crazier, but more esoteric, more active type management stuff. Because you're right, you guys are busy, you don't really have the time to do all of some of this nitty gritty stuff. I think if you have a guy who can help you protect your portfolio effectively, generate some income for it, help you pay for that protection, that's a decent amount to expect from that guy. To be getting in and out on a regular basis, that may be a little bit more of a different expectation level that many of these guys just don't have the time, perhaps, to do that. So, yeah, maybe you're asking too much, and if that is asking too much, but you want to keep your guy, I think we both agree, set up a separate discretionary account that you have access to, and that you could trade, and then everyone's happy. All right, so that's about all the time we have for the mailbag. Great questions here, you guys. I love to give you guys a little bit of time on the show because you write in such great questions, and we don't get the time to get to all of them. And it's only once a month, so we want to make sure you guys get your answer in a relatively responsible and reasonable time frame. So hopefully we got to as many as we could on this show. We'll hopefully get to some more on the next episode. But before we go, as always, let me check in with my cohort here, my co-host, beaming in from lovely scenic Puerto Rico. Randy, what's coming down the pike from you guys over there at Swan Wealth Advisors?
The event or item for us is we're expecting to still launch our international equity DRS version sometime in early December. So we've already filed with the SEC. Hopefully everything comes back and we're ready to roll. I think that's really our next big project, and I think that over the next 6 to 9 months, we hopefully rolling out another couple products like that. So we're kind of moving along our process of taking the DRS to many different various assets that we think can provide value to clients' portfolios.
And really quick preview, what do you think the next asset will be aside from the S&P 500?
Well, I want it to be gold. Fundamentally, the problem is trying to find a wrapper. So it's very difficult to do a gold type strategy in a mutual fund, a 40 Act fund. So we have a track record. It's a very good track record. We're very happy with it. It's just a matter of figuring out the wrapper to place that in. So I think that we'll be making a decision before the end of the year and probably looking for the end of the first quarter launch and something like that, assuming that we can make it viable.
Gold would certainly be a hot one. Energy is also very hot these days, so somewhere in the crude maybe might be interesting too. A lot of different asset classes are heating up these days and might be fun places to look and to take that strategy and apply it out there, the defined risk strategy. Interesting stuff. Of course, if you want to learn more, surf on over to swanwealthadvisors.com. You can find all that stuff as well as their good, the bad, and the ugly newsletter where they break down all the stuff that went on in their positions and in their products over the past quarter, and you can see all that stuff for yourself. And on behalf of Randy and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and, of course, for sending in such great questions. So a special thanks to all of you guys who we featured on the show today. Great stuff. Keep those questions coming, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.